Hi, everybody. This is Brad Wolff, and this is the presentation that I gave in Orlando, Always in Mastering Stop Orders. Before I go into the presentation, I want to first thank everybody that was able to join us in Orlando. It was a lot of fun, and I hope everybody learned a lot of information while they were there. Here are the key topics that I'm going to be discussing today. First, why traders struggle. Second, the goal of Always In, followed by swing trading, breakouts, why it's the most important concept in trading, always in, major and minor reversals, and then examples of always in trends and always in trading ranges. So why do traders struggle? The first reason traders struggle is they lack price action knowledge. Everybody, when they start their journey trading, they quickly realize that they don't know anything about charts. And then once the trader believes that they've studied long enough, they eventually believe that they can get to the other side. So you can see, number one, they haven't studied enough about price action. And then number two, they haven't spent enough time looking at charts. And then traders get to this other side. They become hopeful that if they spend enough time studying, they're going to be able to figure it all out, just like this gentleman has on the right side of the screen. Unfortunately, that is not everything that they need to know. The second piece is they have a lack of organization. Their trading knowledge is unorganized and they're unable to use it at the subconscious level. So what does that mean? What that means is you've gone through the video course time and time again. You know everything. You know what a major trend reversal is. You know how to look at a chart at the end of the day. However, when it really matters in the market and you're watching and you're trading, this is how you feel in terms of information. You have this catalog of information that's all jumbled up and unorganized, and you cannot access it when you need to. So this goes into my third point about why traders struggle, and that is information overload. Again, this is the trader's information, and it's all jumbled up all over the place. And what they have to end up figuring out how to do is organize it at a subconscious level in a way they can use it. And here are various examples of bits and pieces that you have to understand when you're trading. These are all the decisions that you have to make, from trade management to context. And there's a lot of them. And there's many other examples that are not listed here. But for example, is the market in a trend or in a trading range? Is the trading range tight or is it broad? Or is the trend tight or broad? The breakout, is it strong or weak? Along with many other pieces. And that has nothing to do with how you're going to manage the trade. First off, are you going to buy or are you going to sell? Are you going to trade with a stop order, limit order? What about position size? How much risk are you willing to tolerate on the trade? All of those decisions leads to chaos and sheer panic and causes the trader to lose focus. And that makes their trading that much more worse. Traders, they must organize their thoughts. This is how a trader thinks. They organize their thoughts into flowcharts or decision trees, similar to how a computer would use logic. You have a trend or a trading range, and if it's a trading range, is it tight or broad? If it's broad, fade the upper lower 1/3 of the range. If it's tight, wait for the breakout. If it's a trend, is it a channel? If it's a channel, is it tight or broad? If it's broad, trade like a trading range. If it's tight, only trade in the direction of the channel. And again, here is that example of that yard of string. And by forming a decision tree in our minds and thinking of a very top-down analysis on how to trade, we can change our trading from this yarn of string into this nicely colorful example of bits and pieces of yarn. And this represents a trader's organization of their thoughts in a way that'll keep them profitable and thinking about the markets in the right way. This is an example that someone sent me sometime last year about their thoughts of trading. A successful trader goes from here, this yarn of string, into neatly organized bits and pieces. So beginners, they're constantly trading against strong trends. They're fearful that if they buy in a strong trend, that their stop's far away, and if they buy somewhere up here, or if they buy anywhere in this trend and they put a stop down here, they're fearful and paralyzed that they're going to lose money. So what do? They do the exact opposite. Instead, they look to sell below strong bear bars. They think to themselves, if I sell and I put a stop up here, that's a parabolic wedge, and if I'm right, we could plunge all the way down here. If they sell here, same thing. Here's a wedge top, 1, 2, 3. I can sell it, stop above, so the risk is small, and my reward is big. And what they fail to realize is all of those little losses are going to make up one big loss by the end of the day. And there's their stops. You can see they're tight. Now beginners, they must learn to trade in the direction of the trend. The experienced trader is going to take the exact opposite side of that trade. What does the experienced trader do? Instead of selling below this bar, they wait for a second entry and they buy, knowing that the bears that went short are going to exit. The bulls here, they buy. 2 legs down. The bears were at the moving average. They know those bears are not going to be successful in getting a strong trend. They understand the market's been above the moving average for a lot of bars. And if anything, even if it falls below the moving average, odds are we're going to go sideways. Beginners, they constantly bet on breakouts of trading ranges. They're so fearful that whatever breakout we get is going to lead to the next home run, really, really big trend. When in reality, most of those bars, what are they going to do? They're going to fail. So we have a big bull breakout bar closing above all the bars to the left. Beginners, they get fearful that if they think, oh my gosh, if I don't buy right now, then we're going to be all the way up here, well past this screen, and I'm going to miss out on the best move of the day. So they buy at the market. But what they fail to realize is the bulls, they need follow through, and that's their follow through bar. You can see it immediately reverses down. So what do the bears do? The bears say, yeah, the bulls, they had a chance, but no surprise, they failed. I'm going to sell below this bar and put a stop above, betting that we're going to get 2 legs down. Some bears, they sell here, they sell here, they sell the bear breakout, they sell here. The point is, beginners are betting on breakouts of trading ranges, and instead, they should wait for clear breakouts. They need more than just one bar when the moving average is flat. Here's another example. Beginners, they constantly bet on breakouts of trading ranges. Trading ranges are filled with breakouts that constantly trap traders. Here's a bear breakout below all the bars to the left. However, what traders fail to realize is this right here. We have a sell-off, pullback, second leg. And you can see what happened. The risk for the bears is it's a possible second leg trap. Bears that are selling here, what are they going to do? Well, unfortunately, if you get a bull bar above this bar, if you get a bull bar, bears have to exit. And the bulls, they see 2 legs down, failed breakout of the bottom of the trading range. They think, finally, this is my opportunity. I'm going to buy with the stop. Consecutive bull bars, I'm going to buy there. They'll buy the pullback, betting that the odds are we're going to remain in a trading range for the rest of the day. So always in, what is the goal? The goal of always in is to simplify our trading The goal of always in is to simplify our trading and reduce the number of decisions we have to make. Just like that flow chart I showed earlier in this presentation, we want to make a decision tree as short as possible with as few deciding factors as possible to get us in the right direction. So we want to reduce the number of decisions in a day, look for 3 to 5 swing trades in a day. This gives traders a methodology to swing trade reliably and improve the overall risk reward without significantly damaging the probability. So bears, you can see they sell here, they sell closes, then they get out above this bar, it's at the moving average, they can buy here, you get a rally, maybe they get out there, they get out consecutive bear bars below the moving average, bear breakout below a wedge, bulls they can buy here, bear breakout to the moving average, but not enough. They can buy there. Overall, it simplifies their decision. And the goal is to trade in the overall direction, the highest probability direction of getting a second leg. Always in short, odds are we're going to get a second leg down. Bears, they'll sell with the stop above the top of the breakout, and they'll sell anywhere on the way down, betting that they're going to get a second leg. Some of those bears, they'll trail a stop. We get a new low, they move their stop up here. Rally, new low, they move their stop up there. And then we have a wedge bottom, bear breakout below the channel. They exit above this bar because it's a credible reversal. Other traders, they are more frequent than that. Bulls buy, betting on a double bottom and a possible upside breakout, but it's an expanding triangle. So they get out below this bar. Bears sell, they sell more lower. But then we get a bull bar closing on its high, failed breakout of the wedge bottom or the expanding triangle. Bulls buy, and then what do? They probably get out below consecutive bear bars, or they get out on the second leg down below here or here. Bears, they can start selling. Some of those bears might get out on the outside up bar, but a micro channel, probably sellers above. Other bears, they can sell there if they did get out. Bulls, they'll buy here, and then they'll get out below this bar or any of these bars. Some bears will sell again below here if they got out here, and then bulls buy there. So those traders take a lot more, they take more of the minor reversals while still focusing on the overall direction. Most traders should focus on 3 to 5 reversals a day. In other words, they should try to focus on the best reversals that they can find. We have a triangle, breakout mode. Bulls buy the close, breaking above the moving average. They buy this close, and they hold. Where do they get out? They get out when they have a credible 3 pushes up. 1, 2, 3. So we have a wedge, bull breakout, failed bull breakout at the top of the channel, reversal down. Bears, they'll start selling. Bulls, they'll start exiting. And the bears that are selling, betting on a second leg, where do they get out? They'll get out on a second entry, a second reversal up from the bottom of the range, either here or here. And the reason is it's a retest of the middle of the triangle, 2 legs down, leg 1, leg 2, and a possible second leg trap in the middle of a trading range. So the goal of always in, we want to improve our risk reward while minimizing the damage to probability. Another way to put that is we're giving up probability in order to better our risk reward in the hopes of increasing or improving the trader's equation. Most traders are just simply unable to keep their probability high enough to scalp. Bulls, they buy the close and they go for 1R. Bears, they sell below this bar, stop above, and you can see if they stayed short, they would have made 3 times the risk. Reversal from the moving average, 2 legs up and an overall bear sell-off. Bears can sell, and they almost made twice the risk. If they held for a second leg, they would have made twice the risk. Bulls, they can buy, they get out here, so they probably get out near break even. And then bulls, if they buy there, they probably make 1 or 2 times the risk. So you can see, by swing trading, it's improving the risk reward. Rather than trying to just get 1 times the risk, traders are trying to get 2 or even 3 times the risk if the trade permits. Swing trading, the foundation of your trading. Now, why should swing trading be the foundation of your trading? Because it keeps traders in the overall right direction. Opening reversal, always in long, either here or here. Bulls, they can buy the close and they stay long. At some point, we get an endless pullback, maybe consecutive bear bars below the moving average. Bears get out, bulls get out, and bears start selling. Second entry buy, 50% pullback of the always in long rally. Bears get out and bulls buy. Scalpers, they can find several trades on a chart, but they're not going to take all of them. And you can see, this is what a beginner dreams of. They dream of taking 20 or 30 trades in a day, just like this person on the chart. Buying closes, selling with limit orders, buying below bars, selling above bars, all the way up. And they think, yeah, this can be really easy. The reality is, in order to do this profitably, you have to understand swing trading very well. And if you think back to the chart I just showed, bulls are buying all the way up, bears are selling on the way down, and then bulls are buying all the way up. They're following the direction of the swing trade. Scalpers, they understand swing trading very, very well. Bear breakout, as the market's going down, bears are selling. We have a reversal up, bulls, they're buying, betting on a reversal, an opening reversal from the sell-off at the moving average. Bad sell, bulls will buy it. 2 legs down, on a 1-minute chart, bulls will buy this close. Test of the high close of the day, betting on disappointed bulls, bears will sell the close. Big bull bar, tight bear channel, bulls, what do? They'll sell out of longs and bears will sell to go short. Bad low 1, bulls will buy. Second entry buy, right here, bulls will buy above it. Bulls will buy the first bear close. Parabolic wedge, bulls start selling out of longs, testing the high close. Big bear bar at the moving average, bulls will buy it. And there's several other examples not listed. Profitable traders, they understand signs of trending behavior. So what are signs of a trend? Pause the video and think about it for just a minute. One of the signs of a trend is several closes above the moving average. That's probably the single easiest way to decide if we're in a bull trend or a bear trend. Sometimes you can decide that with 10 bars above the moving average. Sometimes it's 15. Generally, I like to see at least 10 to 15 bars above the moving average before I'll conclude that we're trending. Other signs of a trend, multiple negative gaps. When you get a leg in a trading range and you start seeing negative gaps here, here, and here, you know the odds are you are in the early signs of a small pullback trend. Minor reversals, here, here, and here. Whenever the trend is tight, all the bars above the moving average, and you start seeing negative gaps, the risk that you face if you're selling is this. Bears giving up in a strong upside breakout. Once bulls believe the trend is underway, they start buying and building their position, betting that the odds are we're going to go higher. This is what trend traders want. They want to buy aggressively all the way up because they know the odds are, there's a brief window where the odds are really high that you're going to get a second leg. So signs of strength in a trend for the bears. Again, it's important to understand trending behavior. Several closes below the moving average. You can see right here. That's a sign of a strong trend. Negative gaps, another sign of a strong trend. Beginners, they're constantly sucked in to all the bull bars and they think to themselves, yeah, there's no way I can stay short here. This is a parabolic wedge, 1, 2, 3, or 1, 2, 3. This is going to reverse. I've got to buy above this bar. You know, I can't be short down here. And what they fail to realize is on a higher time frame, it's a big bear breakout. And you can see this is that buy we were just talking about. Instead of going up, the market went a lot lower. And bears, what do? They're selling everything. They're selling every bull bar because it's allowing them to sell closer to the moving average in a strong bear trend. Quiz time. We have a wedge. Is this a minor or a major reversal? Pause the video and ask yourself that question right now. If you answered minor reversal, you were correct. A lot of bars below the moving average. The channel is rather tight. We have a series of negative gaps or open gaps here, here, and then up here. This is a tight bear channel. And you can see it led to lower prices. Next question. What are 2 signs of trending behavior? Pause the video and ask yourself that question right now. The first one, negative gaps, which I just mentioned a second ago. And the second one, several closes below the moving average. The reason I'm mentioning negative gaps and several closes below the moving average is swing traders, for really any traders, you have to understand always in trading. And most importantly, you have to understand what a strong trend is. Strong trends are going to have lots of bars above or below the moving average. And then second, you're going to have negative or open gaps. Those are 2 things you can use to distinguish when the market is in a strong trend. Traders, they must understand what's a major and what's a minor reversal. Trend from the open, bull trend, and you can see we have a sharp sell-off. This is a major reversal. Major implies that it's undoing the previous market cycle. So we had a bull trend, we're getting a reversal down. We had a bull trend here, we formed a trading range, and now we're getting a strong bear breakout transitioning into a bear trend. These blue arrows here, here, and here, all of those are minor reversals. Why are they minor? Because the odds favor a trading range a lot more than an opposite trend. And that means they typically get trend resumption down. Consecutive big bull bars at the moving average, traders sell it. 2, 3 legs up, traders sell it. 2 legs up, traders sell it. Minor reversals, the reversals that lead to trading ranges. You have a parabolic wedge, bears exit, and the market reverses down. Big bear breakout, gets 2 legs down, and then goes sideways. 3 legs up, deep pullback. Big bear bar here, but what happened? It formed a parabolic wedge. So minor reversals, the key with understanding minor reversals is you have to count legs. And I'm going to talk about that here in just a little bit. But minor reversals, they're legs in a trading range, which means you have to be very cautious when you're trading them. Whenever you get 2 or 3 legs down, you got to get out. Minor reversals typically lead to trend continuation. When you're in a bull trend and you get a minor reversal here, 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 or here, all of those reversals are typically going to lead to trend continuation, and therefore don't take the sell. Instead, wait for it to fail and then buy. And you can see strong bull trend, no bars below the moving average. Expect reversals to be minor and lead to trend resumption. And this is the opposite. As I just mentioned, bulls, the smart bulls, they're buying right where their bears are exiting the trade. Major surprise. What do? A major surprise resets the market cycle in a big way. Major surprises, they're major breakouts in the start of a new market cycle. And therefore, you expect major surprises to begin a new market cycle. We have a tight trading range here, so it's the end of a market cycle. And then we have this very strong bull breakout here. That's a strong enough breakout that the odds are you're going to get several legs up, and you're probably going to get a prolonged channel. And then we got several bull bars in a row. This breakout might be a breakout on a higher time frame. And then we got a trend line break and a new high. But you can see on this chart in the bottom right of the screen, the next several bars formed a channel and then a trading range completing the market cycle. But if you bought here, which is right here, you had a lot of time to be in the market. That is what always in traders want. They want major reversals that are going to lead to several bars in that particular direction. Swing traders, they're always looking for the dominant feature of the day. Major reversal, big bear breakout here, strong enough bar, always in short, expect some kind of measured move down. And you can see we had a tight bear channel, lots of bars below the moving average, and we eventually reached the measured move target and bears started buying back shorts. This was also an area. This was also a bear breakout below the wedge. We had a wedge, a bear breakout below it, so it's a failed breakout after a series of consecutive sell climaxes. Reasonable to expect the market is going to form a trading range. So look for the dominant feature of the day. Strong bear breakout, odds are you're going to get a couple of legs down. And if you look for this and you see it, then you can rule out the odds are against you're going to get a bull trend day. So it's either going to be a bear trend or a trading range. So looking to sell and scale in higher is a reasonable idea. Or simply look to sell, exit, and then look to sell higher. Breakouts, most important concept in trading. Strong breakouts, they reset the market cycle. Here we have a bull leg in a trading range, although it's rather tight. And then we got a really strong bull breakout. This is a strong enough breakout that you expect a second leg up at a minimum. And typically, the market will form a wedge later on. Here's a minor wedge. And you can see the market sold back off to the moving average. Whenever you get a strong bull breakout, traders are buying. And you have to understand that. If you do not understand why breakouts are so important and why breakouts reset the market cycle, that is going to hinder your success as a trader. Because if one does not understand breakouts, they're not going to understand how to track the market cycle. Strong breakout, again, it resets the market cycle. We had a trading range open and a strong bull breakout. This traps bears and they're forced to buy back their shorts. Bears, they're selling above bars, they get trapped into a losing position, and guess what? They've got to buy back their shorts. And if they don't buy back their shorts, they're going to face a lot of pain. And you can see bears, eventually, they were forced and squeezed out of the trade, and it became a small pullback trend day. Breakouts, they lead to trapped traders. This is a quote from Al's Trading Price Action Trading Range book. You can read it below. This is one of my favorite quotes because basically what Al is saying is the single most important thing that a trader can understand is, are there more buyers above or below the bar? In other words, is the breakout going to succeed or fail? Here we have a tight trading range. Limit order traders, they'll fade breakouts until they get trapped. Bears selling above bars, bulls buying below bars, scaling in lower, bears selling, scaling in higher, back and forth, until eventually tight bear channel, and then we get a strong bear breakout. That bear breakout is strong enough to increase the odds of a second leg down. Why? Bears, bulls who are buying below bars, scaling in lower, they get trapped into a losing trade. And when they get the reversal, a lot of those trapped bulls sell out of longs and bears sell to go short, leading to a second leg. And you can see bear breakout, bears trapped into a losing trade, bulls trapped out of a winning trade. And then limit order bulls, they use the bounces here and here to reduce their loss. Bears, they know this, and they will use any bounce to catch the second leg down. Trading ranges, they typically allow traders out of a loss. We have a bear breakout, but bottom of a trading range here. Reasonable to buy the low of this bar right here, this purple line. Once the market started to go sideways for several bars within the overall range, traders, they begin to correctly buy, believing that the downside is limited. And then those trapped bulls, they're able to exit, break even at their first entry with a profit on their second. And this is why most breakout points close in trading ranges. When the market's in a trading range, the odds are breakout points are going to close to allow the trapped limit order traders out of the trade. Always in minor versus major reversals. Traders must understand the difference between a minor and major reversal because you trade them differently. Minor reversals, they should be thought of as legs in trading ranges. Here's a trading range. Bulls, they're buying here, and what are they doing? They're getting out below bear bars. And that's because trading ranges, they often have breakouts overlapping prior bars that have bad follow through. So you see a big bear bar, bulls buy as it goes down. You see a big bull bar, bulls, they start buying as you get a pullback. Bears doing the opposite, bears selling bull bars, betting that the reversal is going to fail. Traders will look to sell second and third legs in trading ranges. Here we have a rally, 1, 2, 3, and it's a wedge, 3 pushes up. Bull bar, and then a strong reversal down. What do the bears do? The bears that are short, they'll hold, betting on a second leg and get out above this reversal, a failed breakout of the trading range, and 2 legs down. Bulls will buy, bears will exit shorts here, here, and here. And a major reversal should be thought of as a reversal from a trading range into a trend. Here we have a strong upside breakout, always in long. It's a breakout of a triangle here. Strong enough breakout, you're going to get a second leg and trapped bears. So bulls, they'll buy aggressively all the way up. You can see 2 legs down, so a second leg trap. And as I just mentioned a few seconds ago, bulls, they're buying all the way up. Bulls correctly understand that the market is forming a major reversal. Minor reversals, they often reverse after second and third legs. That's probably the most important thing I can say about a minor reversal. Another way to say that is, in a trading range, look for reversals after second and third. Minor reversals often reverse after second and third legs. Here, you can see an overview of the chart, and there's a lot of trading range price action. Moving average is sloped, but there's not a lot of bars closing above the moving average, or at least far above the moving average. We have a double bottom here and here. We have a double top here and here. We have a triangle and a parabolic wedge. All of those patterns have smaller patterns nested to make each pattern up. And this is what I'm talking about. Here, we had a double bottom, and it's 3 legs down. Sell off, pause, second leg, pause, third leg. We have 2 large legs up, and then we have 2 legs down, testing this low right here, the bottom of the second leg trap, which is right here. We have a triangle that I drew earlier, and that is subdivided into 3 legs. We have a sell-off, and it looks like 2 legs down, but if you really count the legs, it's 3. Sell-off, pause, being the inside bar, second leg down, pull back, and then a third leg down, testing the bottom third of the range and forming a double bottom right here. The key point to understand is that it's very common for minor reversals to reverse and go the other direction after 2 and 3 legs. This means that if you're in a trading range and you see 2 legs down or 2 legs up, the risk increases that you're going to get a reversal. Keys to trading minor reversals. You have to understand leg counting. Leg counting is critical when you're in a trading range, and it's the reason that I just explained earlier. When the moving average is flat and you know you're in a trading range, everything becomes minor. And what that means, if there's no major force or major trend on the chart, there's a greater risk that you're going to see a reversal. Here we have a sell-off. But if you look at it closely, it's 3 legs down. We sold off, rallied, sold off again, rallied, and sold off a third time. This sell-off strong enough for a second leg down. But look what happened on the rally. We rallied and reversed. We rallied again and we pulled back. And then we rallied a third time, forming a parabolic wedge. We sold off and then we rallied all the way up here. This rally up to this high creates 2 legs. Leg 1, pause, leg 2. We had a bear breakout, strong enough breakout for a second leg. It got a second leg and then it got another leg down. But this sell-off is also a strong enough sell-off for it to just be a leg 1. Strong enough breakout that it formed a second leg down, leg 2. The whole point is there's many ways to draw the legs. Whenever you think something might be 2 legs down or 3 legs down, especially if you're at the bottom third of the range and you're short, it's usually better to exit. So if you see something here that could be 2 legs down and you see a strong bull bar closing on its high in the bottom third of the range, it's usually better to go ahead and exit your shorts. If you're long and you see a rally and it looks like it's possible parabolic and it's in the upper third of the range, or if you're long up here and you see a big bear bar closing on its low and it's already 2 legs up in the upper third of the range, it's usually better to sell out of your longs and exit, or exit on a bounce. In other words, sell above this bar or on one of these closes, or as the market is reversing down. Major reversals. They're reversals that form opposite trends. Here we have a wedge, bear flag, 1, 2, and 3. The swing bears, they'll sell the minor reversal hopeful that the sell-off will become a major reversal in a bear trend. So bears, they'll sell right where my mouse is, and they'll put a stop a couple of ticks above, taking a chance that this will form a strong bear trend. And that is in fact what happened on this chart. We have a very big bear breakout. Bears that were short will add to their position. Bears that were trapped out of the market that were not short, guess what they'll do? They will sell and look to scale in higher. And those traders will sell for any reason on the way down. Now the keys to major reversals. Seeing strong closes beyond the moving average. What does that mean? What that means is the moving average is a reflection of the overall trending behavior. The more one-sided the moving average is, such as this, rally, pause, and all the bars above the moving average, it's clearly bullish. When you see a strong bar closing far below the moving average, especially one closing on its low, you know that limit order bulls are trapped. Bulls buying below bars and scaling in lower, they have a problem here. And if they did buy and scale in lower, they're going to use any reversal up to sell out of longs. And that's why this bull bar here, traders sold it. So traders will sell the close, they'll sell below the bar, they'll sell on the pullback, betting that this bear bar alone is strong enough for a second leg down. Reversal traders, what they want to see is a strong close beyond the moving average with follow through. Here, you didn't quite get the follow through, but you got the follow through later on in the move. And you can see on a 240-minute chart, these two bars with the bull bar in between them is this right here, a big bear bar, and then a tail for the follow through, but it closed on its low. So the key point is understanding when price closes far below the moving average, it traps traders and it increases the risk of getting a second leg. I call this an always in flip, where the market is flipping directions by crossing the moving average. But you want to see the moving average cross in a strong way. The key to major reversals, again, you want to see a strong close below the moving average. Tight trading range, big bear bar. Major reversal is an opposite trend. You want to see the reversal go far beyond the moving average. A moving average is a reflection of trending behavior. And if bars are above the moving average and you see a strong bar closing below the moving average, it increases the risk that you're going to get a second leg down. You can also call this a major surprise. And again, surprise breakout, always in short, expect a second leg down. And this is that same chart. Lots of bars closing below the moving average. When the market is in a tight bear channel or a small pullback bear trend, bears will begin selling strong closes, and they'll sell below anything closing on its low or closing below its midpoint. Here's a one-bar major reversal. When you get a bear breakout and it's a major surprise, it's very common for the market to get a second leg. Very high probability that you will see the second leg. However, when the market has a lot of trading range behavior, you'll often see a pause before you get the second leg. And I call this a delayed second leg. We have a bear breakout here, but what's the problem with it? There's several reasons this bear breakout is problematic. It does not mean that the bear breakout is going to fail. What it means is it's probably going to get a delayed second leg. We had a gap up. This is a bull breakout. And then we have a tight trading range on the open. And then we have this one relatively large bar. The fact that that bar is very big and climactic increases the chances that it'll see profit taking on the bar. And look at the moving average. We broke below the moving average and we closed below the moving average. But look at the bar. This bear bar, the majority of the bar is actually closing above the moving average. So it's really more bullish than bearish in terms of context, even though this sell-off is strong enough that the odds are you'll get a second leg. So instead of traders selling the close, what they will do is they'll look to sell a pullback. You'll often hear traders refer to this as clarity. As soon as there's clarity in the market, a big bear breakout, it's really common for the market to pull back and go sideways. Again, major reversals, they need to break beyond the moving average. Here, we have a bear breakout closing on its low. Now, why did it reverse and fail? Well, the problem is it's already a second leg down. We have a bear breakout, as I showed on the prior slide. We have a pullback, which was a delayed second leg, and then we got the second leg down. If this market was truly bearish, it would not be doing this. Think about it from the perspective of the bears. If you're a bear and you sold the close of this bar, how are you feeling at this point down here? You've had to hold for a long time just to make a profit. And even then, if you sold the close right here, your actual risk was all the way up here. Although you would have made your actual risk and probably twice your actual risk, this is not consistent with strong trending behavior. The other problem with this sell-off, these 4 bear bars closing on their lows, is it's climactic. We have a bar inside of this tight trading range here. Same thing with this next bar. It's growing in strength. It's a bear bar closing on its low. The follow-through bar is good as well. It's closing on its low. But what is wrong with this bar right here? It's similar to this bar right here. It's a little bit too big relative to the bars to the left. What's very common when you're in a trading range is for the market to go far, to go beyond the moving average in a big way. You can call it several standard deviations away from the mean, which is the moving average. And when it does that, price wants to test back to the average price, in this case, the mean. And it causes the market to snap back to this price level. And that creates a second leg trap. Bulls, you'll have bulls buying above here, buying more lower, confident that they can get out break even. Higher probability, if you're a bull and you're looking for the reversal, don't buy here. Wait for a clear breakout above the moving average right here. This is one of my favorite slides. If you're going to be an always in trader, you have to understand breakouts. And the reality is, if you're going to be a trader at all, you have to understand breakouts. Understanding breakouts is going to teach you a lot about the market. Everything is a breakout. If you look at any chart and you look at a 5-minute chart, there are roughly 81 bars on a 5-minute chart. On average, there's probably about 10 to 11 inside bars on a given day. An inside bar is the only bar that's actually not breaking out of the prior bar. And what that means is there's about 71, give or take, breakout bars on a given 5-minute chart if you're looking at the day only. And that means that the majority of the bars are breaking out, and it's critical to understand breakouts. Now, why are breakouts important? Breakouts trap traders, and they do it by one of 2 ways. They trap traders into a bad trade, in this case, the bulls. You have bulls buying below bar 1, which is a zoomed in snapshot of this chart down here. Limit order bulls buying below 1. And what happens during bar 2? We'll look at the 1-minute chart. If you bought below 1, which is somewhere, I believe it's right here. If you bought below bar 1, you're buying here. And what happened if you scaled in lower? You'd scale in lower, and price would immediately go lower. So if you're a limit order bull and you buy once here, and you scale in another 2 or 3 points lower, and then you scale in another 2 or 3 points lower, any of you traders that have done that, you know how painful it can be when you're scaling in against a strong breakout. Those bulls who are trapped on the losing side are going to be desperate to sell out of their losing trade and get on the right side. Al calls that a pain trade. And the bears, what's happening to the bears? The bears want to sell a pullback, but they're not getting filled. What that creates is desperation and momentum for traders to sell and get into the market. I remember this day because if you actually look back at this chart, the market was only going down a tick or two. It would go down a tick or 2 or 3, pull back a tick and go lower. It did not give traders the opportunity to enter on a pullback. It forced bulls and bears to chase the market down. This is why breakouts are so important. The more you realize, the better you can understand if traders are trapped, the better position you're going to be in to capitalize on the trapped traders. Here's an opposite example, very strong buy the close rally. And think about it from the bear perspective for a minute. If you're a bear and you're selling, you sell here, you scale in again. How are you going to feel when you see 2 more bars against you? You're going to be experiencing a lot of pain. You're going to be forced to buy back your shorts relatively quickly. And what that's going to do is force traders to desperately buy, either buy to get long or to buy back their shorts. The bulls, they know that. They see what's going on. And what are they going to do? Every time they see a bull bar closing on its high, they're going to add to their position all the way up. Context can improve the odds of getting a major reversal. On the left, we can see a 5-minute chart. We have a wedge bottom, 1, 2, 3. Swing bulls, they'll buy above this bar, taking a chance that it's an opening reversal and a possible low of the day. The opening range is not all that big, and therefore we may get a measured move from the low of this bar to the high of the day session and a measured move up. By understanding the context, we can actually better calibrate what the expectation behind the trade should be. Here's a higher time frame chart. We've been in a bear trend, we pulled back and we sold off for quite a bit. So it's a spike pullback channel. We're breaking below the channel right here. And today, what happened? We gapped up on the open. We gapped up and we sold off, forming a higher low major trend reversal. So buying above that green arrow over here is actually buying a higher low major trend reversal on a higher time frame chart. And you can see what happened. The market rallied for the next day and a half, testing the top of the bull channel. Trends, they often begin with minor reversals. Here, the market gapped down and we formed a trend line break and we formed a higher low major trend reversal. When you look at this chart, if you look at the first 10 bars, 15 bars of this day, it does not look like the start of a strong bull trend. And yet, when you look all the way at the end of the day, you say, well, of course, the bull trend started all the way here. This was the low, we formed a higher low, and then a small pullback bull rally for the remainder of the day. All trends begin with minor reversals. Small pullback trends, they begin as bull legs in what will become that look like trading ranges. We have a trading range, and something important happens here. We start to get a series of bull bars above the moving average. And at that point, the market's in a small pullback bull trend. We start forming gaps. Gaps here, gaps at this breakout point here, and even up here. Traders, they must look for signs that minor reversals are becoming trends. And that's what I just talked about. We have open gaps here, open gaps here, open gaps here, and 14 bars completely above the moving average. That is a sign of trending behavior. Major reversals, they trap traders into losing trades. Here, the market gapped up and we sold off, forming a wedge bottom. And the bulls got a second entry. The market rallied and began to go sideways. At this point, the odds are high that the bulls will get a second leg. Always in long, expect a second leg. However, here, this is where bulls trapped the bears. Bulls got a series of bull bars closing on their highs with a lot of open gaps and several bars closing above the moving average. Think about it again from the limit order bears. If you're a bear selling above bars, what do? You sold this high, you scaled in here, you added on here. At this point, you're in a lot of trouble. And if you continue to scale in, you're going to risk facing severe consequences to your P&L. And because traders know they're on the wrong side of the trade and they're experiencing a pain trade, those bears are going to be forced to buy back their shorts. And they're going to buy back their shorts quickly. Bulls know that, so what are the bulls going to do? They're going to add to their position. And that's what creates a strong upside breakout. On this chart, you can see that we gapped down on the open. And then we rallied, testing the moving average, breaking the trend line, and forming a higher high major trend reversal. So we rallied, trend line break to a higher high major trend reversal. Bears will begin to sell, and bulls will begin to sell out of longs, taking a chance that this higher high major trend reversal will reverse the trend. When you see a big bear bar closing below the moving average, and then you see follow through here and here, this is a very big problem for the bulls. Bulls, they were hopeful that the market would stabilize at the moving average, and instead of stabilizing, the market is actually breaking below the moving average and finding follow through. That increases the chances that the first reversal up will be minor. Remember what I said, when there's clarity and the market's breaking below the moving average and it's always in short, usually the market has to go sideways for at least a few bars before you get the second leg down. And that's what happened on this chart. Down here, we had more than 20 bars below the moving average, and we're in a bear trend. You can call it a wedge bottom, 1, 2, 3. But even though it is a wedge bottom, it's a minor reversal. The other thing about this chart is it's a spike in channel. It's 2 legs up. But what do you notice about the moving average? It's actually against the overall moving average. And on the prior day, this was a sell climax after trending environment. We had a gap down and then we rallied. So it's a sell climax. We rallied for a couple of legs, but it's a minor reversal on a higher time frame, and that's why the market went sideways on this chart. Trading always in with trends. Here is a strong major reversal late in the day. We opened with a lot of trading range price action that you can see through here. Trading range price action here, strong bear breakout, but what happened? Because the market was in a trading range, it got a delayed second leg down. Leg 1, leg 2, possible failed breakout of a final flag, the final flag being this trading range here. And then at some point, you can see bears selling above the leg 2, hoping for another leg down. What happened? Bears were forced to buy back their shorts. The bulls, they formed a tight bull channel, and then eventually they broke above the moving average and got follow through. In situations like this, when one side is not all that strong, there's added risk that if you break above the moving average, especially if you do it in the form of a micro channel where the channel is really tight, it traps the limit order bears selling above bars, betting on a second leg, and they get squeezed out of the trade. And bulls, they'll buy aggressively, betting on higher prices. And obviously we went a long way up. Wedge bull flag, minor reversal in a bull trend. On this chart, we gapped up, and a gap up should be thought of as a breakout. So whenever you see a gap up and you see a reversal attempt, usually it's going to go sideways and lead to trend resumption and get a second leg up for the bulls. We had a strong bull breakout, and it was a second leg up. While it was a second leg up for the gap up on the open, it's a strong enough breakout that the odds favor a second leg after this rally. So bulls, they'll buy the close and they'll look to scale in lower, betting on a second leg. Some traders, because this bar right here is climactic, they'll buy, scale in lower, and look to exit back at the high close. Other bulls, they'll exit below the second entry and then wait for a couple of legs sideways to down. 1, 2, 3. And then when they get a bull bar closing on its high right here, they'll buy again, betting that the market will get trend resumption. The market tried to rally through here, and it started to stall. Some of those bulls will exit and look to buy again here. Other bulls will stay long, taking a chance that this leg here at leg 1 will get broken, which it did here and here. Always in short, a reversal with 1 bar. On the open, there's a 50% chance that you will get a major reversal within the opening range. What that means is roughly 50% of the time, you'll get a reversal of the initial breakout. Bar 1 was a bull bar, and then we had 3 consecutive bull bars. But when you look at this rally, here, here, and here, it really doesn't look that strong. There's only 1, maybe 2 bars closing above their midpoints, and therefore it looks more like a bull leg in a trading range, and you know the odds favor the market falling below. This is also a gap up, and yesterday was likely a bullish day, and therefore there's added risk that this rally is actually a breakout of some kind of bull channel. We had a strong bear breakout closing on its low, and it's a strong enough bar that the odds favor a second leg. So what will bears do? Bears will sell, they'll scale in, betting on that second leg down, and they'll sell all the way down and sell the pullbacks until the bulls have a credible bottom. Can the bulls buy here? Some might, but it's really not ideal. A bull buying right there, they're realistically going to buy more lower. But because of all the buying pressure here, here, and here, it increases the risk that this is a bear leg in what will become a trading range. Strong reversal in the open, we have a very big bear breakout. And occasionally, when you get a gap up and you get a big adverse bar against the gap, it can often make the market always in short with just one bar. Al calls this a major surprise. Major surprise are events that are strong enough to create second legs, and often a measured move of that initial surprise. And that's basically what we got on the open, a measured move from the high to the close, projecting down. Bear channel, pullbacks are minor reversals. So what does that mean? Here we have a trading range open, and then we had a strong bear breakout. But when you look at the bear breakout, it's really not as strong as it could be. The odds are high it'll get a second leg. But if you're selling at this point here or here, you're selling late in a sell-off that really began up here. And there's a lot of trading range price action here. Look at this bear bar. It's big, and there's a tail below the bar. And so far, if you compare this bar, where my mouse is, compared to all the bars to the left, it's one of the bigger bars of the day. Sell climaxes usually lead to pullbacks. Traders will sell and scale in higher. Other traders will take profits down here and then sell after 2 or 3 legs up. Why would they sell after 2 or 3 legs up? Because they understand that on a 15-minute chart, this sell-off right here, which are these bars here, is just a 1-bar sell climax, and the odds are high it'll get a second leg. All of these boxes are minor reversals here and here, and even right here. And what do you notice about the minor reversals? Traders are unable to close gaps. This gap is open right here, the close of this bar to the high close of this bull bar right here. This gap is open, close of this bar, or the close of either of these bars and these high bull bars right here. You can also say there's a gap here. Any of these bars here and the retest right here. Whenever you see open gaps, you know the market is trending. Trends, they need strong context to get an always-in reversal. When you look at this chart, it's really easy to find the parabolic wedges in the bear trend. And if you do that, what you're going to end up doing is, at the worst case, you'll end up buying every reversal attempt. And by the time you look back at the end of the day, you're going to have a lot of small losses that are going to rack up a large loss at the end of the day. Best case, you'll find parabolic wedges all the way down, and you'll be unable to enter in the direction of the trend. The key is understanding that whenever you see a wedge and it doesn't last that many bars, and no bars are crossing the moving average, the key to understand is that every one of those are minor. Here, minor reversal. Here, minor reversal. 3 pushes down, it's minor. Bulls can't make money above bars. 3 pushes down here, it's minor. Bulls, again, cannot make money above bars. 15-minute chart, this is a very strong breakout, and that's what this is on the 5-minute chart. So whenever you see parabolic wedges, you must understand that it's minor. The lack of consecutive bull bars means that the bull bars are small, and on a higher time frame, they're just small dojis. Even though you have a series of bull bars right here, that is not enough to get a major reversal. You need 10 bars and 2 legs, and then 10 bars and 2 legs. This rally, even if it's impressive by the bulls, it immediately gets reversed. And that's why the market went sideways for the rest of the day. Always in reversal above the moving average. The day opened as an expanding triangle here. 3 pushes up, 1, 2, 3, 1, 2, 3. Whenever you see big bars and then big reversals, you should always be leery of the day. The market formed a double bottom here and here, and we formed a small pullback bear sell-off down to the low of the afternoon session. Even though it is a small pullback sell-off, look to the left. Just because it's in a tight bear channel and you have a lot of bars below the moving average, if you look to the left and you see important support, such as this blue line, you know there's added risk that this could in fact be a double bottom that leads to a reversal. The bears, they will exit above a second entry, such as this bar. A lot of bears may exit above this bar right here and not sell again on the way down. In either event, more bears will exit above this bar and bulls will begin to buy. At some point, the market breaks above the moving average, pulls back, and then finds more closes above the moving average, and you'll have more and more bulls buying aggressively, confident that the bears are trapped. The bears selling above bars and scaling in, they barely had room to avoid a loss, and if they didn't exit on their losing trade, the bears took a big loss later in the day. Here is an example, an always in reversal in the form of an endless pullback. This was the Friday, May 31st, right before the start of the Orlando event. The day gapped up and immediately sold off on the open. It's a strong enough surprise with closes below the moving average that the market's always in short. And because of that, you'll have bears who are selling aggressively, betting that bulls are going to be forced to sell out of longs at a worse and worse price. Traders are selling all the way down, but at some point, the market becomes too climactic. We got a bear breakout below the bear channel here, and then the market started to stabilize. Bears, if they're selling, what are they going to do? And at some point, if they're short and they're scaling in, what are they going to do when they see a bull bar crossing the moving average, and then another bull bar crossing the moving average here, here, and here? Those bears are going to be forced to buy back their shorts for a loss. And the bulls that are trapped out of the market, betting that this was going to be some kind of bear flag and lead to a trading range or lower prices, they have to look at this and reevaluate. They know the bears are trapped into a losing trade, and therefore those bulls have to find a way to get long. You can look at this chart and say that it is a V bottom, and while in part that's true, it's really not a V bottom. I say that it is a V bottom, but there's many ways you can classify it. You can call this a failed breakout below a bear channel. You can call it consecutive sell climaxes. The whole point is to understand on a higher time frame perspective, this was a sell vacuum test of support on the daily chart. And once the market reached that support level, the market reversed up quickly. Next, we're going to talk about always in when you're inside of a trading range. We have a trading range with several minor reversals. Remember what I said earlier, minor reversals, you know leg counting is critical. And whenever you see second and third legs inside of a trading range, it's usually better to exit the trade, especially when you're at the bottom or top of the range. All of these are minor reversals. By the time the direction is clear, usually you see a reversal soon after. Strong bear breakout, we pulled back and we tried to get a second leg, but it's against the strong rally. Here we have a strong bull breakout up here, but it's in the upper third of this range. It got a small second leg and then went sideways. Big bear breakout, but by the time it's clearly bearish, you had a deep pullback, an attempt at a second leg down, and then an even deeper pullback, and then a larger second leg down. Swing traders, they expect minor reversals to fail. Bears, you had traders selling all the way down. And the bulls were also buying the breakout points. They're buying here, scaling in lower. Those bulls, even though they're trapped selling during the leg one, those bulls are confident that if they scale in lower, they're going to avoid a loss. They buy anywhere in here. They buy more lower. Some try and get out break even. Others scale in. They get out break even on the entire trade here. Others hold and exit at their original entry. And what that creates is a retest of the breakout point. The bears know that. The bears know that majority of the time breakout points get retested, especially in a trading range. So rather than selling all the way down here, a lot of bears will wait for the retest of the breakout point and sell either below this bar or this bar once they are confident that bulls are selling out of longs. Scale in bulls buy, they buy more lower, or they buy above a bull bar here or here. Then they exit at their original entry. Minor reversals, again, you must count legs. Just because you see a relatively big bull bar and it looks like it's undoing the bars to the left, that's a very, very dangerous way to trade. In general, traders should structure their trades where they always have at least a 1-to-1 risk reward. Traders buy the close, stop below. But if a trader does that, what happens? They're quickly disappointed. And one of the unfortunate things that beginners do day in and day out is bulls buy, they put a stop down here, and then they immediately get stopped out here. And then they think, oh my gosh, the market's reversing. I better short because this is going to turn into one of those really, really big bear trend days. So a trader takes the loss on the long, and then they immediately go short here, and they end up getting out all the way up here. What they fail to realize is they're buying 3 legs up, leg 1, 2, and 3. And when the market's in a trading range, everything is a minor reversal. And when the market is experiencing minor reversals, you know that you're going to see reversals after second and third legs. Dangerous to buy really big bull bars closing above a lot of bars to the left when it might be a third leg. The smart bulls, even if they took that trade, which is really not ideal, they'll be quick to exit below a bear bar closing on its midpoint. And the smarter bears that see this setup happening, they'll be quick to sell as the market reverses down. And this is another example of a minor reversal. On the open, the bulls see a high 1. We gapped up, pulled back, and we have a bull bar. It's a high 1 buy setup. However, it's following a relatively big bear bar. And because of that, bulls that are buying here, they will be quick to exit if the market starts to reverse down. The unfortunate thing that bulls will do, especially beginners starting out, they don't understand this is probably going to fail. They buy here, they see the market start to stall, and then they see this bar race up and they think, finally, we're going to break above the range. This is going to be a really strong bull trend day. And then all of a sudden, when this bar starts to go down, they're in denial. They cannot accept or fathom the thought that maybe this isn't an ideal trade, and maybe this is a failed breakout of a bull channel, 1, 2, 3, and a reversal down. In other words, they cannot fathom the thought that it's a leg 3. And what ends up happening is they end up selling out of longs all the way down here. It's a strong enough bar that the odds favor a second leg, but if you're selling this outside down bar right here, it's really not ideal. You're probably not going to make 1 times the risk. And therefore, a lot of traders selling down there, you can see what they're going to do. They're going to buy back their shorts above a bull bar. Bulls buying right here. They buy. They're hopeful that this is going to be some kind of double bottom and it's going to race up here. But when this bar starts to rally and this next bar is a bear bar, what they fail to realize is it's an expanding triangle. 1 push up, 2 pushes up, 3 pushes up, and they just bought the start of a third leg. Bulls, they buy, they get stopped out 1 tick below the bar, and they're forced to buy again here. The whole point is to recognize that when you have clarity, a lot of times that clarity is after a second or third leg, and usually it leads to a reversal. Traders are better off waiting for a wedge bottom at support or wedge top at resistance with a decent buy signal bar or a series of bull bars. And here, the market started to rally for several legs. Here is an example of a minor reversal within a bull trend. Here, the bulls have a spike and channel or a small pullback bull trend. And you look at this big outside down bar. It's a strong enough bar that some traders will call it always in short. But are those always in short traders looking to hold for 2 legs and 10 to 20 bars? Not really. Those always in short traders are holding for a second leg down. And therefore, they'll sell below the bar, which is not ideal, or above it for a scalp in a second leg down. But they know that a lot of traders are going to buy back their shorts over here. And this is an example where it can be dangerous for the always in bulls, the always in bears, to sell hoping for a second leg. This is what traps a lot of traders. They end up looking for the reversals. They miss the entire rally. They see the reversal, and you have naive bulls or naive traders selling, hoping that it's going to be the start of an opposite bear trend. They're unable to buy back their shorts here, and then they take a big loss all the way up here. And worst part, they miss a strong trend day. Trading ranges, they're notorious for flipping the direction at the extremes. In a trading range, you often reverse once the market becomes clearly always in long or always in short. Here, we have a bull breakout, always in long, but late in the rally with strong selling pressure. There's increased risk of a reversal soon. We have a brief second leg up, and then we've had a decent sell-off, a retest of the highs, and then a strong breakout below the moving average. As soon as there was clarity in the market barely went higher and then went sideways and built selling pressure. Now we have a bear breakout here. We got a second leg down and then a stronger third leg down. It formed consecutive sell climaxes, and it's easy to think, wow, this is going to be the start of a strong bear trend. But you have to step back and look at all the overlap and then look at where the market is. The market is testing support at the bars to the left here, and it immediately reversed up on the next bar. Always in bears, they're forced to buy back their shorts during this bar. And like I said, a sudden reversal from the low of the day, common in a trading range. Leg 1, 2, 3, parabolic wedge. Trading ranges, they flip the always in direction at extremes. One of the worst things that traders do when they're starting out is they see strong bars and they immediately begin buying closes or selling closes without regard to where the breakout is occurring. They see big bull bars and they buy. They see big bear bars here and they sell. They sell because they think, well, Al says strong breakouts, they get second legs, I'm going to sell. They sell here, and then they buy here, and then they sell here. And before they know it, they've racked up really, really big losses. And because of that, what traders become naturally good at, or at least they think they become naturally good at, is learning how to fade breakouts. At some point, they do the opposite. They start selling these breakouts, buying these breakouts, selling these breakouts, and then buying these breakouts. But then they run into the issue of small pullback trends. And what happens is they end up getting trapped, just as I mentioned a couple of minutes ago over here. They end up selling. They buy this breakout, and then they sell this breakout. But once they start selling it, they get trapped into a really, really big loss. So the key is to recognize the difference. When you see 2 legs down in a breakout at support, it's better to wait for a pullback or don't take the breakout. It's common for the market to become always in short on the second or third leg of a trading range, which increases the risk of a reversal. leg 1, leg 2, reversal up, and then leg 3. You can call it a second leg trap, 1, 2, and then a reversal testing the top of the second leg. And because of that, you'll have bulls waiting for the reversals and buying once they see the reversal happen. Always in reversals. Here is an example of a wedge bottom reversal of the moving average. We opened with a lot of bars below the moving average. We formed a wedge, 1, 2, 3. It is a bear trend and it's always in short, but it's not clearly always in short. It's 3 legs down, 1, 2, 3, and then nested with the third leg forming a wedge, 1, 2, 3. And whenever you have a bear trend with a lot of overlapping bars and the market looks like a leg in a trading range, usually it's better to not stay short and look to sell pullbacks. Always in bears, a lot of always in bears will exit above this bar. And bulls, once they see follow through, especially follow through above the moving average, they'll begin to buy expecting a second leg. Bulls, they buy expecting a second leg up. But now, top of a trading range, those bulls begin to look to sell. So the swing bulls, they'll use this area to take their profits. In this video, I talked about why traders struggle, the goal of always in trading, why swing trading should be the foundation of everybody's trading, breakouts, why breakouts are the most important concept in trading, always in, minor versus major reversals, examples of always in within trends, and then examples of always in within trading ranges. Thanks everybody for watching this video. I hope everyone finds it useful.